Hello, I'm Elon Auerbach with Unitrust Mortgage in San Diego. Welcome to Mortgage Watch, offering you insight into financial, real estate, and mortgage news that affects your life. Bond markets, which set mortgage interest rates, were down 100 basis points yesterday on Thursday. So far, they've been up 115 basis points today, continuing the recent whipsaw effect. These are staggering numbers. The financial markets continue to feel like riding a roller coaster in a hurricane. Many of you have asked me how we got into this crazy situation, with stocks and bonds going up and down so dramatically almost every day. Well, let's start by looking back over the past 20 years. After the Enron and WorldCom disasters and swindles like that cost people billions of dollars, new and tougher accounting and accountability standards were instituted. In the U.S., that included the Sarbanes-Oxley Bill and Basel I, an international accord named after the Swiss city of the same name. These were designed to provide transparency and greater accountability to prevent mortgage and real estate financial fraud. After the tech stock crash in 2001, the U.S. Federal Reserve started lowering interest rates to keep the economy from a recession, much like we're in now. The resulting lower interest rates were great for homeowners and commercial borrowers alike. Many prime borrowers got rates in the 4s and even 5s, depending on their loan programs. With so much low-cost, easy money flowing, the Wall Street firms started offering low-cost mortgages geared for subprime and even option prime borrowers through their clients. The start rates on many of these loans were unnaturally low. They reset very quickly, sometimes after a matter of months, and their actual real rates were alarmingly high. This low cost of money also encouraged Wall Street and other large lenders to make loans with much easier qualifying, as you've heard. Lots of bad loans were made, and things started to turn ugly when some of these borrowers couldn't afford the changing terms or even sometimes the beginning terms of their loans. At the same time, investors weren't happy with the low rates of return they were getting on their investments, so Wall Street started coming up with new, highly complex loan pools, also called securities, that promised higher returns by mixing in subprime, option arms, and even auto loans. How do these complex mortgage securities perform? How do they work? Honestly, they're so complex that even the people who created them don't really know and couldn't tell you. It's sort of like watching an old Frankenstein movie on TV, where the inventor doesn't know how to control the monster once it comes to life. Only now, instead of just ravaging the countryside, the mortgage security monster threatens to ravage people around the world, from Florida school boards to banks in Germany and local governments in the U.S., Australia, and Asia. Then we mix in all the accounting rules that were created to establish the transparency and prevent fraud, and it becomes an even uglier mess. These institutions are required to write off losses to their market value, but no one, at the institutions or otherwise, knows what that really is because they don't really understand how these vehicles work. How can these investments, though, be worth nothing, since the underlying asset is real estate? Even if the real estate backing these securities had gone down 15 or 20%, that asset should still be worth 75 to 80%, certainly not zero. Another interesting note that's just come out is that, banks have gotten in trouble because they need reserves of capital or money to cover the $100+ billion of write-offs they've had in the last 8 months. Gee, they gave out $100+ billion in dividends last year to the shareholders. If they'd only known what was going to happen, they could have held on to that money, would have avoided a lot of the crisis that we have going on. Why don't you think of everyone at a giant party that we've gone to, eating some of the stew that's there. Tastes really good at the time, but a few hours later, everyone starts getting sick. Some just mildly, others need to go to the emergency room, some have acute food poisoning, and a few actually die of a fatal bacterial infection. This is very much like what's going on today with the securities and the mortgage market. So we're often asked, is it as bad as it seems? Well, no and yes. No, because in the end, the actual losses probably won't be as bad as they now seem, and there'll be a lot of money recouped in the coming months or even years. Yes, because there's a lot of real pain and suffering out there. Thousands of people around the United States have lost their homes in foreclosure. Entire blocks of some Midwestern cities are now vacant. Did you know that in Detroit, you can buy a house for less than the cost of any car? It's true. Even in areas not so hard hit, Just a few foreclosures in a neighborhood can be very stigmatizing and affect values very, very severely. The mortgage, real estate, and construction industries have had hundreds of thousands of jobs laid off. The economy is battered, and the effect is being felt by everyone. But what does this mean for your home and real estate in general? When will the market recovery come? If the economy is so slow, why aren't mortgage rates lower? These are all good questions. We believe that things will improve over the next 6 to 12 months, although not as fast as we would like. The Federal Reserve was frankly very, very frozen and waited way too long to take any action. Unfortunately, that cost people a lot of money, their homes, and jobs. However, now with the government stimulus bill having been passed, the higher FHA, Fannie, and Freddie loan limits will help. Their increased involvement in pooling loans and selling loans will help stabilize the financial, mortgage, and real estate markets. Of course, none of them is actually ready to accept, buy, and package these higher loans at this time. These are giant entities, and like giant locomotives, it takes them a little while to get up steam, get those wheels turning, and start moving down the track. But they are going to be doing that, and when they do, it will offer real relief. We think in the next 4 months, they'll definitely get going and start to have some effect on the marketplace. Relief is in sight, but we're not there yet. Freddie Mac predicted this week that 30-year rates should be in the mid-5% range by the summer or early fall, down from about 6% where they are now. So that's very welcome news for everyone. What can you do? Well, for starters, stay calm. Be in touch with a real estate or mortgage professional who can help you sort out all of this information and provide real insight on your particular situation. Whether you're in foreclosure, looking to refi your mortgage, or take advantage of the enormous opportunities out there right now in buying a new home. Remember, you'll want a seasoned expert professional on your team. Thanks for tuning in to this edition of Mortgage Watch. If you'd like to ask us questions or get further information, please email me at info@unitrustmortgage.com or visit our website at unitrustmortgage.com. Thanks very much, and we look forward to speaking with you soon.